Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis and a warm welcome to my podcast Money Talk for Wednesday the 26th of April. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, President Joe Biden has confirmed he will run for re-election for a second four-year term as president next year. Vice President Kamala Harris will again be his running mate. In a video released Tuesday, Mr. Biden cast the next election as a fight for democracy and personal freedom and implored voters to let him finish this job he began when he took office. South Korea's economy grew more than expected in the first quarter of this year, buoyed by rising private consumption, which offset a contraction in corporate investment as the semiconductor industry declined. The economy expanded 0.3% quarter-on-quarter in the 3 months to March, following a 0.4% contraction in the previous quarter. Bank of Japan Governor Kazuo Ueda stressed the need to keep monetary policy ultra-loose for now, but said the central bank could raise interest rates if inflation and wage growth overshot expectations. His comments come ahead of the BOJ's two-day policy meeting that kicks off tomorrow, which will be his first meeting he chairs since taking the helm of the central bank earlier this month. And US regulators are attempting to come up with a plan to stabilise regional lender First Republic Bank after its shares plunged almost 50% on Tuesday. First Republic Bank's deposits fell by over $100 billion in the first quarter. The bank is reportedly in touch with the US government as it struggles to come up with a viable rescue plan, such as a sale of all or part of the bank. On today's programme, I'm joined by personal wealth advisor Enzio von Pfeil and Hao Hong, chief economist at Grow Investment Group. With a view from Japan is Tokyo-based journalist and author William Pesek. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks fell Tuesday following a mixed bag of earnings reports and as fears about the stability of regional banks return. The S&P 500 finished 1.6% lower at 4,072. The Dow tumbled 345 points, or 1%, to end at 33,531. And the Nasdaq Composite slumped 2% to close at 11,799. San Francisco-based bank First Republic crashed over 49% after it announced it lost more than $100 billion in deposits in the first quarter. Its shares are down 93% since the start of the year, and US regulators are reportedly meeting to come up with a rescue plan for the bank. The KBW Regional Banking Index tumbled 3.9% to a fresh low for the year. After the closing bell, Microsoft reported first fiscal third quarter results that beat on both the top and bottom lines. Overall company revenue increased 7% year on year to almost $53 billion in the quarter ended March the 31st, and net income at just over $18 billion was up 9%. Shares of Microsoft rose 8% in after-hours trading, and Google parent Alphabet reported revenue for the first quarter that topped estimates. Alphabet's revenue rose 3% to almost $70 billion from a year earlier. Net income dropped to $15 billion from $16.4 billion a year earlier. And the company said its board authorised a $70 billion share buyback. Shares of Alphabet rose 1% after the close. Hong Kong stocks fell to a 4-week low led by the tech sector. The Hang Seng Index dropped 342 points, or 1.7%, to 19,618. That's the lowest level since March the 27th. And since reaching a year high on the 27th of January, the Hang Seng has fallen 13.5%. The tech index slumped 3.5% in its biggest decline since early February, and that's now down 10% over the past 7 trading days, and more than 20% from this year's peak on January the 27th. On the mainland, the Shanghai Composite Index retreated 0.3% to 3,264, and that index has lost 4% over the last 5 days. This morning, futures markets are pointing to further declines for Hong Kong stocks. The Hang Seng is projected to open 250 points lower. That's a decline of 1.3%. In the bond markets, US government debt rallied and yields fell. Deposits are shifting from banks to money market funds, and that's pushing the short end of the yield curve higher as those funds invest in short-dated treasuries. The yield on the interest rate sensitive 2-year Treasury tumbled back below 4%, falling 19 basis points to 3.96%. And the cost of insuring against a default in US government debt jumped to another record high as so-called X-Day nears, when the US Treasury will run out of money and be unable to raise new funds unless Congress approves an increase in the government debt ceiling. And elsewhere in the markets, the US dollar was stronger on haven flows and Brent crude oil tumbled 2.4%. And you can get more details on the latest movements in the markets in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our guests. We have with us capital preservation specialist Enzio von Pfeil, our regular Wednesday commentator. Morning, Enzio.
Morning, Peter.
And also with us is Hao Hong, chief economist at Grow Investment Group. Morning to you, Hao.
Morning, Peter.
Well, as you heard there, Chinese markets have extended their slump. One other index I suppose I should mention, the Hang Seng China Enterprises Index of Chinese stocks listed in Hong Kong, that fell 2% yesterday. It's lost more than 5% this month, and it's now the second worst performer among more than 90 global equity gauges, which are tracked by Bloomberg. What's gone wrong for Chinese markets? What do you attribute this to?
Hong Kong is actually, one of the worst performing market year to date. But recall that, the Hong Kong market started to rebound at late October last year. So, the rebound has been fast and furious, right? So, from the bottom to the top, Hong Kong Hang Seng Index has bounced more than 50%. Right? So now we're giving some of the gains back. But even so, the speed at which the loss is accumulating is somehow surprising, given that the Chinese economy is recovering and also the Hong Kong stocks is still very cheap. So I believe that it surprised many people, how fast we're losing the gains.
And the other thing that surprises me is the timing, because it came almost to the day that we had that economic data where we got better than expected GDP product figures. We also had this huge, almost 15% surge in year-on-year exports in March, but the markets just seem to have ignored all of that.
I think the market has been anticipating some recovery. And so I think even though the GDP figure is better than expected, but I think most people are looking at the monetary policy, for further support for the market and also for the economy. I think for the first 3 months of the year, monetary expansion has been, the highest on record in history. Right? So, people think that, maybe it's time to take a pause, because, we have released so much liquidity into the system. It's time to wait and see how effective the policy has been. So to determine the next step. And also we know that monetary policy works with a lag. And I think that is the reason why PBOC is pausing as well. So even though in recent days, the PBOC has been injecting liquidity into the open market system, but it's mostly because of the Golden Week holiday that is coming at the end of this week.
The top leaders in Beijing do seem to be concerned, don't they, about this recovery, even though we had the good GDP data, retail sales, which beat expectations. They were talking about a recovery that was quite unstable. They were talking about consumption not being strong enough and wanting to maybe boost consumption, particularly in rural areas. Do you think that's put people off, just hearing the nation's top leaders, maybe themselves, expressing concerns?
I think consumption is actually better than expected. And, if you look at the retail sales, it's going up 13% year on year. It's way exceeding expectation. But what's worrying is the investment part of the economy, especially in the property sector. For some reason, the property developers are still not putting money back into building new houses. And as you know, the property sector is like 1/4 to 1/3 of the Chinese economy. If the property sector is not recovering generally, there will be no recovery for the entire economy.
Enzio, I know you've been concerned about the consumption in China for a while.
Yes.
You see it as being just too low in terms of percentage of GDP.
Yeah, structurally, it's about a third of GDP, whilst in normal developed economies, it's generally, in my experience, about 75% of GDP. So I think that there's a lot of room for expansion, to put it nicely. But if people don't consume because they're scared about their jobs, especially outside those booming areas of Shanghai and Shenzhen, for instance, there are various pockets of boom in China, but my friends who've been there recently are saying that not all of China is booming. It's just these individual beacons of light, but not the whole place. The other point being with the exports, yes, it is true that they rose 14%. A lot of that is because of the friend shoring, but I think that most people, and I certainly am part of that group, would think that if anything, we're going into a global slowdown, global, not recession, but a slowdown, a form of stagflation, a mild form of stagflation. So I think that again is going to hit the Chinese economy, on top of course, demographics, which is a much longer term issue.
I've heard some fund managers express the view that March export number is quite dubious. They're not really convinced that there is a strong recovery in exports going on, particularly when you look at the state of the global economy. What do you think?
Well, I tend to agree with that, because if you look at the dry bulk shipping rates, they've been tumbling down yet again on the shipping side. Surprise, surprise. And the consumption also in the U.S. I mean, you just, if the U.S. does slow, the world cannot defy gravity. I don't know of any economy anywhere in the world that has done well off a credit crunch. I just don't know of one. I don't think this time is going to be different. The credit crunch, the Fed tightening, is now being replaced by the credit crunch of the banks themselves, of the private sector banks, and also this huge shift away from bank deposits into Apple and deposits with the Apple computer companies. And so there's a lot of structural shift going on that it's going to sort of put a dent in growth, in my mind, in the US and thus globally.
I saw a figure actually today which said that M2, the money supply in the US, has actually contracted for the first time in 90 years. That's not a good sign, is it?
Well, it's been going. They've only started their proper tightening back in April of last year, and now with the credit crunch coming through, also, as you say, the M2 figure has to decelerate massively and shrink, just because the banks are not going to lend as much, and when they don't lend, the place doesn't grow. Sorry.
Let me ask you a bit more about consumption. I mean, we obviously, when we look at the Chinese economy, we think about Shanghai and Beijing and Shenzhen, but we tend to forget that 900 million of the population live in the countryside. The government says it wants to get rural consumption growing and boost that. How does it do it?
Well, I think if you want to boost consumption, you must boost income. All right, so for the longest time, I think the income share of Chinese workers in the overall GDP is one of the lowest internationally speaking. So, unless you can boost income growth substantially, it's very difficult to boost consumption. So I think for now, China remains as a consumption-led investment-driven economy that is driven by infrastructure spending and also by property.
Isn't that the problem? The Chinese leaders, they have this common prosperity policy which seems to focus on social engineering. But as you say, the only way really to improve people's livelihoods and to get their wealth up is to basically find better jobs, create more jobs, better paying jobs. But then when you look at those employment figures that we had, nearly 1 in 5 young people are out of work. Graduates can't find a job. That's the root cause of the problem, isn't it? Or one of the problems.
Yeah, I think it's also a function. The young youth unemployment situation is also a function of economic growth slowing down, right? So as you know, 1% of GDP growth can generate about 10 million jobs in the Chinese economy today. And nowadays, each year, the Chinese system produces 12 million new graduates annually. Right? So basically, you have more supply of labor than demand of labor. And also, there are other people who are looking for jobs as well. So that is the reason why, the youth unemployment situation is particularly acute. and it's very difficult to resolve. So the very high unemployment rate among young people has been persistent for some time now. I think for over 2 years now, ever since the COVID outbreak. And I don't think there is a sort of a comprehensive solution to the situation just yet.
Can I just add to that, Peter, if I may, that I think there's also a huge educational mismatch, not only in China, of too many graduates and too few vocationally trained people who repair the cars, the pipes, the ceilings, the electricity, all that. And I just hope that does at some point kick in, this vocational training that the Germans, the Swiss, and the Austrians excel at, because that's steady income. A house doesn't care if there's a recession; its roof will fall in.
And government officials last week were suggesting that actually too many people are going to university, and some of these graduates should give up their professional ambitions and be prepared to take lower paid manual jobs. Do you think that's the solution?
Yeah. Well, I mean, it's a solution. It's part of a solution, but I just think it's this educational mismatch between everybody having very extravagant expectations of high, nice, air-conditioned, cool jobs in big, fat merchant banks and investment banks, and nobody really wanting to stoop to the level of wanting to be a waiter, even in Hong Kong, or of a delivery man, of a repair of houses, bridges, construction, all this kind of stuff. But that has to be done. If you don't construct the bridges and keep the electricity repaired, then you can forget the rest.
Hal, let me ask you a bit more about the markets itself. Tell me about earnings. How are earnings looking, and how are valuations looking for the Chinese market? Is that one of the reasons why maybe we're seeing this sell-off?
Yeah, I think for the first quarter, most people are not expecting much. So far into the earnings season, we're seeing very high single-digit earnings growth that is largely matching people's expectation. Right, so there's really no surprise there. And this move in the market is not generated by earnings disappointment, but more by geopolitical risk, and also by how well the Chinese economy has been performing. I think, so far, if you look at the geopolitics development, basically Biden is going to announce a new round of and more hawkish sanction on, technology industry. Right? So, I'm hearing that, there's an expansion of the sanction into, some new industries such as biotech and other, key industries, technological industries that Chinese is trying to develop into. So I think that is a huge concern, and that is the reason why the Chinese ADRs in the U.S. lost over $100 billion US dollars worth of market cap in the past months.
And these new sanctions, they also threaten investment flows as well, don't they, into China, which is going to be a first. Are investors concerned about that as well?
Yeah, it is concerning, because we're hearing that the new sanction can be imposed on new investments into the Chinese technology industry, and also, some of the American PE funds won't be able to put money into the Chinese tech sector anymore, right? So that basically restricts new capital going into the system, and then, as you know, R&D and technological breakthrough really needs to burn money. So I think that is sort of, suffocating and taking the oxygen out of the system.
Sorry, Enzio.
Sorry. If I may just add to that, in my last book on trade myths, I also mentioned what I call host country protectionism. I would not be surprised to see mainland China, out of justifiable annoyance with these American congressmen, beginning to thwart some of the activities of U.S. companies in China itself.
Well, they are already, aren't they? They're targeting Micron, the semiconductor manufacturer,
they're
under investigation.
To that a little bit. I'm just surprised that the U.S. business community has not risen against these hot-headed congressmen who are really just pulling cheap shots at China, because everybody agrees that China is a bad country in America, which is complete nonsense, of course.
And of course, how this is all coming at a bad time anyway, isn't it? Because we're seeing a general slowdown in demand for semiconductors. We saw that in those Taiwan export numbers last week. Taiwan Semiconductor Manufacturing, TSMC, has also said it's going to have the lowest annual revenues since 2009. Do you think this is all combining to lead partly to the sell-off? Because some of the biggest stocks that have sold off seem to be in the chip sector.
Yeah, I think semi shipment has been slowing since late last year, and this is because during the pandemic period, many factories basically build up semi inventories, right? So now, given that there's a global slowdown, therefore there's less demand for chips, and as a result, they are basically working off the very high inventory level they have accumulated during the pandemic. So it's not too surprising to see shipments from Taiwan is actually slowing as well. But I think, if you look at the Chinese demand for chips, it's actually increasing, right? Especially, now the Chinese car industry, the electric car industry is taking off big time. BYD is toppling off Volkswagen becoming the top selling vehicle in China. And as you know, cars making, it require a lot of chips. But these are like middle to low end chips that China is buying. I think the high end chips, that is used, for example, AI, that is being manufactured by NVIDIA, it is not available anymore in China. The H100 is not available anymore in China. I'm hearing that, the smugglers in Shenzhen who is buying H100, the very high end chips,
right,
in the cafes in Shenzhen.
And how does China get around this? Because it needs these chips for, particularly as you mentioned, for AI, don't you? For things like ChatGPT, they need really high-end semiconductors. How does China get around all these curbs that the US is putting on it?
Yeah, I think for now there's really no good way. Basically, you have to bypass the circumvent the sanction by some illegitimate means. To get your hands onto those high-end chips. And also, there are, some inventories in China as well, before the sanction was applied on many of these chips. And also China is pouring lots of money, lots of capital into building up its own chip industry. And as you know, Peter, even though the high-end chips are, hard to come by these days in China, but, you can sort of achieve the same result by using a lot of low-end chips, right? So that basically means that you have less efficiency in the system and more power consumption, but it's still doable. And also many of the products that you use in your daily life, they don't actually need like very high-end chips, right? So even for example, in cars and also in national defenses, such as the missile guidance system, you don't need like very, very high-end chips that is being produced in the US right now. So I think, China is trying to get by, by sort of applying a lower technology chips into sort of daily use for now. And I think hopefully over time, all the investments that we're putting it in, China can develop its own, chip industry.
Enzio, this is all going to get worse, isn't it? Because we had that Financial Times report on Monday, which says the US is going to try and strong-arm other countries like South Korea into trying to prevent their electronic companies from making up the shortfall for Micron. So this is all seems to be escalating.
Well, the Americans...
Sorry, Enzio.
Yeah, no. Having lived in America many years, it's they have many good parts to them. The energy level, the mental resilience, but the one part that isn't so good is they seem to think that everything is a football game, a U.S. eyeball to eyeball squad hitting the other squad. There could only be a winner and a loser. There cannot be two winners. I just have a different view, having studied history a little bit, that you can actually do a win-win. But with China and Ireland now being the only unifying spots in the American landscape in the run-up to the U.S. election, I'm afraid that this is only going to, this swaggering and telling others what to do on the American party, it's only going to worsen, and it's going to worsen for some years, I'm afraid.
How are you about to say?
Sorry, how?
I was, just saying that, the sanctions are sort of encompassing from all directions. All right, so it's basically trying to corner Chinese development and sort of, retard the pace of Chinese development.
Yes.
So it is unfortunate for China, and Enzio is right. It is likely to be, years in the making. So I think, many people in China is basically facing up to reality and trying to develop its own system. Now, as in, for example, in the AI space, right? So there's a huge rivalry going on between the domestic Chinese tech firms and also the US tech firms. The Chinese tech firms are coming up with, the Chinese language-based AI system. But as you know, AI needs a lot of data, and I think the foreign firms, the US firms, doesn't have access to a lot of Chinese language data. But on the contrary, the Chinese tech firms actually accumulated huge amount of Chinese data over the years. So I think this is one example to show that China is not completely out of options. There are many ways to compete.
Now, one other thing that's been cited as a reason for the sell-off here in Hong Kong are capital outflows. The Hong Kong Monetary Authority has intervened 7 times so far now to support the Hong Kong dollar this year. The aggregate balance, which is the amount of deposits held by local banks at the Hong Kong Monetary Authority, has dropped below 50 billion Hong Kong dollars. That's the lowest in 15 years. Enzio, how much is this a concern, do you think, for local investors?
Yeah,
okay, I'll take the lead. Thank you, Hal. Thank you very much. Well, I think it's very much a mercantile concern. I'm not going to sort of agonize on this one. It's just that the U.S. short rates are very, very high. You in your notes this morning cited 2-year treasuries at 4%, basically 10 years at 3.4. Well, 1 month is at 5.02, 3 months and 6 months are at 5.3, 5.4%. So it's that very strong interest rate differential which is not being passed on in Hong Kong. So the Hong Kong rates are much lower than the U.S. rates, and it's just an old-fashioned arbitrage action, which over time, once they do finally raise the rates here, they can solve that problem that's a problem that can be solved very easily by just raising the Hong Kong rates.
Yeah, I totally agree with Enzio. Basically, the Hong Kong short rates are just too low. The HKMA hasn't been following the Fed's pace in hiking interest rates. So as a result, there's a selling pressure on the Hong Kong dollar, and basically in the Hong Kong banking system now you can do a US dollar deposit for like more than 5%, maybe 6% annualized interest rate. So people are basically converting the Hong Kong dollar into the US dollar deposit, and as a result, the aggregate balance in the banking system is very, very low, and it is concerning. If you look at the chart, it's basically more or less the same as 2008, and for people who has a bearish opinion on the market, that obviously add fuel to the fire.
Interesting, yeah.
Hal, finally, let me ask you then, to put your neck on the block a little bit here, how much further has this sell-off got to go, do you think, and where would you be looking for a bottom?
Yeah, my trading range forecast that is set out late October last year was between 18,000 to 23,000. So interestingly, the peak of this rally stopped at about 22,800, right? So it's only 200 points away from my top of my range. And I think 18,000 ish is quite likely, and we're going to see that very soon.
And does the market look cheap at those levels, or even at these levels now?
It is always been cheap. So cheap is not the reason to buy.
Okay.
Yeah, wise.
Good to hear your thoughts. Thank you both very much indeed. You heard there Hal Hong, who's Chief Economist at Grow Investment Group, and Capital Preservation Specialist Enzio von Pfeil.
Peter Lewis's Money Talk.
I'm joined now by Tokyo-based journalist and author William Pesek. Good morning, William.
Good morning, Peter.
This is an important week, isn't it? The Bank of Japan. First time we have a new governor for 10 years. Their first meeting is going to be on Thursday and Friday. Normally, Bank of Japan meetings tend to sort of pass by uneventfully, but not so much recently. What are you expecting from this?
Well, I mean, not a whole heck of a lot, frankly. I think that Governor Ueda is still trying to get his feet wet, trying to get a sense of where Japan's economy is, where inflation is, but also what the political environment is in Tokyo and, the broader tolerance, if you will, in the political spectrum for the BOJ to begin tapering at some point or even just beginning to present a plan for an exit. So I think for him, this is a week of kind of watching and waiting and just talking to policymakers and getting a sense of where things are going. He's kind of telegraphed for the most part that we shouldn't expect any fireworks on Friday when the statement or the announcement comes out. So if the BOJ does do something interesting, it will be a big shock to global markets. So it could be interesting.
And what is it that's stopping him doing what the rest of the world's central banks are, which is basically raising interest rates? Because he also has inflation, which is well above target now in Japan. So he's got every reason to do it. What's stopping him?
Well, I think that Japan is really worried about becoming the epicenter of the next financial crisis in the world. Because Japan's been at zero rates for 20 years, it's become the biggest creditor nation. So basically, investors for 20 years now have been borrowing cheaply in Tokyo and moving that money into higher yielding assets in the U.S. and Europe, India, New Zealand, South Korea, Indonesia, you name it. So whenever the yen gyrates, it tends to pull the rug out from under global markets. Also, I think Japan is essentially addicted to 20 years of free money. And I think there's a lot of concern here that after, the Silicon Valley Bank episode in the U.S., after the Credit Suisse episode, that there's a lot of regional Japanese banks that, are not ready for global prime time and are not ready for the BOJ to step away from free money. And so I think, Governor Ueda, his big plan at this point is to just take a look at the situation with the regional banks and to get a sense of how systemically risky the BOJ stepping away from free money will be. That's the problem with 20 years of zero. It's very, very hard to step away from it.
And on the regional banks, it's not over, is it, in the US? We're seeing now problems for First Republic Bank. Its shares are down 50%. Effectively, it looks like it's going to have to be rescued by the US government. So there's more pressure on the regional banks when people were starting to think that the banking crisis is over. And of course, Japan has got a lot of small regional banks as well, hasn't it?
Exactly. Japan has more than 100 regional banks spread around the nation. And the problem is that a lot of these banks are serving what are effectively dying communities, right? It's an aging population. There's not a lot of demand for new homes, for new cars. And so a lot of these banks in Japan, they make all their money the way that SVB did. They buy government debt. And that's exactly why Japanese regulators are looking at regional banks here and taking a deep breath and hoping for the best. So if you're Governor Ueda, you really are stepping into what I would argue is the worst job in global economics. You have to find a way to step away from 20 years of free money without crashing the financial system. And it's easier said than done. And that's why I don't expect a lot from the BOJ this year. But I could be wrong about that. We'll see.
And the Bank of Japan is apparently considering conducting a comprehensive review of the monetary easing steps it's taken over the past decade. You almost think, well, good luck with that, don't you? Because when you do that type of review, it presumably can only conclude that it hasn't worked out that well.
Exactly. And, the BOJ's balance sheet is now twice the size of Japan's annual GDP, which is a first for a G7 economy. I remember back in December, on December 20th, the BOJ tried to pull off the slightest tweak in interest rates. They basically let 10-year yields rise to about 0.5%, and all hell broke loose in global markets. The yen surged, Wall Street panicked, and so I think the BOJ is looking at that episode. They're looking at the extent to which they're levered, and it's a difficult moment for them. Japan's economy is reasonably stable at the moment. Inflation is arguably easing, but it's very hard to step away from 20 years of basically being the world's ATM.
How on earth does it get out of that when you hold more than half of your government bond market on your balance sheet and you've had this 10 years of zero negative interest rates? How on earth do you get out of something like that? It's almost impossible, isn't it?
No, it is. It really is. It's almost an almost impossible job. And I think a lot of it relies, too, on the Federal Reserve. I think a lot of Japan's window to step away from 20 years of free money will be when the Federal Reserve stops raising interest rates. And we're really not sure when Jerome Powell will indeed, basically call the end to the most aggressive tightening cycle from the Fed in 30 years. And that's a big variable. I think at the moment the BOJ is just in technical mode. They're just trying to do their best to keep yields in the U.S. and Japan from drifting too far apart.
Now, another area where there could be some fireworks, the G7 meeting, which is taking place in Japan on May the 19th. It's going on at the same time that the US is talking about more pressure on China's economy. It's talking about restricting investment flows into China. And there's also reports that it's going to put pressure on other G7 nations to maybe follow suit. Where does Japan stand on that?
Well, Prime Minister Kishida has been very close to President Biden thus far. I think people got excited about how Donald Trump and Shinzo Abe seemed to be close. But I think that was a kind of a forced shotgun marriage, if you will, a convenience. I think that Kishida and Biden really are like-minded officials in many ways. And I think that, Prime Minister Kishida, with approval ratings in the high 20s, is looking for some wins on the global stage. And so I do think that Japan will stand firm with the U.S. in any of these sanctions that Biden announces. So it's fascinating, really. People think that Trump was hard on China, but Biden is going after very critical parts of their economy with surgical and methodical precision. I really do think that Xi Jinping in China misses Trump terribly at this point, and the G7 is going to put that on, basically is going to highlight that fact.
Trump's sanctions weren't particularly effective, were they? And if anything, he shot himself in the foot with some of them, damaged his own economy more than China's. But Biden's sanctions are hurting.
Yes. Well, I think that a lot of Trump's sanctions, they did more damage to Japan and South Korea than they did to China. And I think the officials in Tokyo and Seoul are very, very bitter about that. But I do think that, Biden has to be careful as well for blowback in that direction. And I think, you have President Yoon of South Korea, who's in the U.S. this week, basically lobbying President Biden to give Korea a pass on U.S. tech sanctions towards China. Japan will be asking for that as well. So I think that Biden has to be very careful to remember who his friends are in this regard and to make allowances, if you will. I hope he does.
And there's talk about putting pressure on the South Korean government to maybe sort of put the screws on their tech companies not to provide chips to China to fill up the gap if Micron gets sanctioned in retaliation by the Chinese government. Do you think Japan's willing to do the same thing with some of its tech companies?
Well, I think Japan will be very wary about doing that, but I think at the end of the day, they might feel like they need to. And I think, what's interesting, you see the way that South Korean companies, the electric vehicle companies, are investing pretty heavily in the U.S. at this point, and that's going to get China's attention. And you see here in Japan, companies like Toyota are upping their investments in the U.S. as well, which is something that Biden loves to tout, if you will, in Washington. But I do think the G7 is going to be a fascinating moment for Western-China relations, and I think that Xi Jinping and Vladimir Putin in Russia are both dreading the outcome of these talks. We'll see.
Is this going to be the main focus then of the G7? Going to be China? Going to be trade, particularly the technology sector, and also maybe Taiwan?
Yes, I think Russia as well will come into firm focus as well at the G7. But I do think that China and the U.S. relations will be front and center, and the ways in which that relationship has fallout, collateral damage, if you will, for Japan and South Korea will be very much on the table as well. So it'll be one of the more consequential G7 meetings we've seen in some time. It'll be interesting. And it's happening in Hiroshima, which also has all kinds of historical echoes. So it will be a fascinating few days in Western Japan.
Well, we'll have to talk to you again around the time of the G7 and get your thoughts on the outcome of that. So once again, William, thank you very much indeed.
Thanks, Peter. My pleasure.
That's William Pesek, Tokyo-based journalist and author. Thank you for listening this morning. I'll be back tomorrow with more business and finance headlines. To discuss them, I'll be joined by Andrew Ferris, the CEO of Economist Advisory. and Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. And with a view from Singapore is Jeff Howie, who's market strategist at the Singapore Exchange. If you want some more information on some of the top stories from the region, please take a look at my daily newsletter, which you'll find on peterlewismoneytalk.substack.com. I'll see you tomorrow.
Money Talk